Before we get into the economic data of Asia, we just wanted to do a quick rehash of some recent developments on the geopolitical front concerning China and India. Now, we've have followed this very closely. We were very timely in our May 29th, 2020 show where we talked about a coming issue or conflict between India and China, and here we are. We're at in Ladakh on the line of actual control, or LAC. Now, it's the Himalayas. It is very cold. There's a lot of snow cover. So typically things slow down and you don't see a lot of fighting during that time period just because people will harden assets, bring in reinforcements, try to rotate different people because it is a little cold. So, but we have to look at what has been done in the near term in a very contested area. And there was recently a video that was launched by China showing an Indian and a Chinese division essentially staring at each other with not only personnel, but also military equipment. You could legitimately throw a baseball and hit one of the guys in the head on the other side of the LAC, which is why when you consider the importance of a demilitarized zone, you kind of get the idea, because it doesn't take much to see some of these issues, and this is all. And the reason why we're talking about it now is we're getting a ratchet up of rhetoric from the U.S. following what's happened on during the weekend, which we'll touch on in a second. But India also captured a Chinese soldier that wandered to the wrong side or was potentially spying for China on the Indian side of the LAC, who is now essentially a prisoner of war, or at least someone who's under arrest. So again, this is why when we look at what's happening, right now we've seen tanks, MRLs, anti-air, and artillery moving into the region for China. And you can see here that the video, which is the one I'm referring to of the two facing each other, happened in this area. Now, we also have an increase in building of new assets, which there's a picture that we have later on that shows that they've been increasing the amount of equipment, and you could see the training area all the way to the right. But there's a lot of build outs that have happened, not only with just bringing in new equipment, but also increasing the amount of bases and support at that base that are really kind of creating this backdrop. Now, in Hong Kong, over the weekend, they arrested a bunch of pro-democracy protesters and leaders of those protests. You have several people in parliament that have resigned. The UK is extending their rights to Hong Kong citizens if they're looking to get out. And they just arrested a US citizen who is a human rights lawyer. So again, there's a lot of unknowns right here. And now most recently, which happened while we were filming one of the earlier segments, the US is going to bar entry of all cotton products and tomatoes from China's Xinjiang region, where it says Beijing is oppressing Muslim minorities, and again, coming to the Uyghur. And the move is the latest in a string where the U.S. is raising pressures on Chinese companies as we continue to ratchet that up. Now, this is just looking at the LAC, Ladakh, and looking further into the western part of India, where you have India, China, and Pakistan that kind of have these moving borders or disputed borders. But this one is also important to appreciate because this is taking place right in near Sikkim on the other side of Bhutan. So when you think about where the issues were in Sikkim, right over here, then you have Bhutan, you have the issues in the Doklam Plateau. Now this is a little bit further over. And what are they doing? They're hardening their aircraft shelters. Why? Because both sides of the line, the Chinese side and the Indian side, have increased and expanded a lot of not only their helipads, anti-aircraft, but also their military and airport equipment with the shelter. With them, you can see their ongoing painting, which they right now have hardened aircraft shelters to protect aircraft so that they can take direct hit from enemy fire. Again, these are things to consider, and you have to think about what are they preparing for. Now, when we look a little bit different and we look at some of these different components now on different levels of the overall side of Tibet. So when you think about Tibet and you think about what's happened there, we've been talking about how iron ore, steel has been increasing exponentially, and a lot of these individuals from Xinjiang have been sent to Tibet work camps. And this is some of the things that are coming out of those work camps, where we see 2 tunnels that are being done. Now, mind you, if you put these pictures in front of me, without them being, essentially properly marked by the individuals off of Twitter, and their Twitter handles are embedded. If you're not following them, you should, because they're fantastic data in breaking these down. I would never be able to understand this. But you may think, well, they're just making it up. No, they're not. They've been very good. They've been spot on. And that's why we trust a lot of the things that they're saying, especially because they provide data to Stratford, geopolitical futures, and other types of, well-regarded and respected publications. So here you can see 2 tunnels that are visible, the excavated sites. You can see the build out of a lot of these airports. And again, this is offsetting what is happening on the other side of the line in India. And these are again, pressure points that we like to look at when we're talking about China and India and what does this mean going forward. And as we get closer to the spring breakup, where we come to the thaw, we'll do another kind of deep dive of what happened in 2020 and what do we expect to happen in 2021, especially between China and India. And then we start to kind of factor in where does Pakistan fit into the mix. So now when shifting to away from the geopolitical and more to the economic, we can here look at, okay, Chinese economy, what ground is it made up versus the U.S.? So you can see obviously the U.S. still has the advantage just given where things sit overall. But when we look at the U.S. and China, the GDP continues to close. But why is the GDP closing? And obviously the U.S. is just as guilty, or if not more so, on different levels of spending and stimulus and increasing, essentially just, inflation in general. If you consider inflation at 2%, us growing at 2.3%, and then you think about how big the G has gotten, well, how weak is the consumer and the industry been? But anyway, when you look at China, you have to consider the spending on a different level. They're spending exponentially to try to close this gap. Now, that's just one side of the equation as the U.S. budget deficit continues to grow. But total financing, looking at, and we have charts on this as well, but right now the debt in China was up 1.7 trillion renminbi in December to finish the year at 285 trillion, or 280% of Chinese GDP, which is up from 254% in 2019. Now, it's important to appreciate that a lot of this spending is happening, but you have to consider how is it capitalized. So the difference is that in most countries, the spending funded by the rising debt is expensed, whereas in China is mostly capitalized. So that means that the impact on wealth and growth is very different, and it's just where is that going to shake out, and how can China maintain that? Because they're talking about normalizing monetary policy, slowing down debt, but now that we have a renewed lockdown, more people getting essentially bolted and welded into their homes. How are they going to reduce debt and try to get back to growth, as you're starting to see China say that they're not going to invest in the rail system the same way they were expecting, and they're not going to invest in certain projects the same way as initially talked about, just as a means of essentially cutting cost and trying to limit spending in general. And this is going to be something to watch as they try to continue to take that GDP move. And as we talked about earlier, China input costs continue to rise, and as if we just look, China is 70% of the iron ore market in terms of their consumption, coal, and if you look at prices have exploded, and they've still maintained their exports and taken market share, but again, it comes at a cost. And we had estimated it, and this other gentleman had estimated it to be about let's call it 1.2% of GDP in expenses to maintain these benefits. And the cost of buying GDP points is becoming very, very aggressive and very expensive. And that's why we think that China is going to have to start to, or will start to see some slowdown, whether or not they want to. And this is looking at the new outbreak. So when we look at Habib and some of the most recent issues, we see that there was a big spike, but the confirmed cases, so when we look at asymptomatic cases, so when we look at Xinjiang back in October, November, you can see that there was a big spike in asymptomatic cases, but this is a big increase in confirmed cases and asymptomatic. And you can see that there's been a very large increase. Now, if you remember back, I have no idea if the pictures were staged or real or what. But in order to show on how China had beaten this disease, there was a huge crowd of people in Hebei celebrating the new year. So where are we now? We are 2 weeks after this big, gigantic party celebrating the new year. Did that happen, or was that a super spreader event creating this? And now, was it staged? Were those people tested? Was there all types of things? I don't know. This is China we're talking about. I don't know. All I know is the numbers are going up, and this is going to weigh heavily on how much people move, or what are the abilities for people to move during the Lunar New Year, which is big for diesel, which is big for gasoline, which is big for consumer buying, which is big for travel. This is going to weigh on that GDP growth. And if you think about the monetary policy trying to reduce overall exposure or reduce the debt levels and normalize monetary policy, this is going to weigh on those goals as the pressure continues to mount. Now, when we look at net investments in emerging markets, you can see that Chinese debt continues to grow, Chinese equity not as much, because there is continued pressure. So there's a recent comment, and I might have this on another slide as well, where the Chinese police are saying that they're going to enforce anti-monopolistic powers more aggressively. Now, if that isn't a shot across the bow at the tech companies within China, specifically Alibaba and Ma, I'm pretty sure I don't know what is, given we've been talking about this for the last 6 weeks on how Ma is going to be public enemy number one, Alibaba specifically, which is when you look at Chinese equity, well, why would you go into the equity when you can go into the Chinese debt? Now, the debt has its own issues, which we will show about on how spreads have started to blow out, as there's been some concerns on Chinese debt and what that debt's going to look like. And here you can see, just in emerging markets in general, there's been a reduction of exposure in some of these markets, which, I mean, given as we look at high frequency data and what we expect going forward, it's going to be hard to see a big snapback, but there will be pockets like Taiwan, Vietnam continue to be very big bright spots on trade, on economic growth and activity. So there will be opportunities. But then we have Malaysia, which just announced declared a state of emergency because of COVID. Japan and South Korea remain in some form of lockdown. So again, it's going to be bifurcated as to who benefits the most. And when we look at spiraling input costs, this is what we want to talk about, because it's being subsidized at the corporate level, and then at the corporate level, you can only subsidize for so more, and then you have the CCP and the PBOC subsidizing. So at what point do we start to see sales revenue, profit margins adjusting, and as we see those input costs increasing? Because PMI is rising around the world, as we showed in segment 2 when we looked at JP Morgan PMI Global Composite. China is no different. So you can see profit margins, in terms of the diffusion index, what the sales revenue remains. This is going to be a bigger and bigger problem as we go into the new year, as they look to try to maintain exports, as they see additional pressure overall, and the bigger gap that we were talking about. So the spread between strong and riskier corporate debt in China is widening as people are demanding a higher yield for riskier corporate debt. Why? Because we've seen a huge wave of defaults. And for anyone that's been involved in defaults in China, you know that it can be very opaque on what your recovery value is. How do you get your recovery value? Who trumps you in the waterfall? Why did some assets all of a sudden belong to the province, even though they were said to be owned by the company, and that was used as collateral to issue the bond? And long story short, there's a lot of interesting accounting maneuvers that can happen. And when you start to look at the riskier and riskier side, especially with SOEs and more specifically provincial SOEs or state-owned enterprises that have been allowed to go bankrupt, that is putting even more concern on that corporate debt level as China tries to open up and get people more interested. So when we look at still, Chinese companies have raised north of $140 billion in the U.S. since 2000. So clearly the follow-ons have been in 2020 as the debt market opened up. People look to not only do some convertible debts, but we saw an increase in not only secondaries, but first IPOs, as well as debt levels. But again, and this is the quote that I was mentioning before, the mission for China Peace, focusing on creating a market-oriented, rule of law-based and international business environment, we should promote the improvement of relevant laws and regulations, severely punish relevant crimes in accordance with the law, and strengthen the enforcement of anti-monopoly laws. Authorities are also looking to up their long-arm jurisdiction game. We should speed up the formation of a coherent legal system for the extraterritorial application of Chinese laws. So again, we're seeing this move of trying to force, and this comes back to the dual circulation system. When we look at demand side reform, supply side reform, this is right in line with trying to force some of those supply side reforms and demand side, where we're going to start to see more talk about inequality, fighting poverty, even though they technically eradicated poverty. But you're going to see a way to try to drive the consumer. But the supply side remains a problem. As we've talked about in our show, Chinese Communism Rising, this is going to be a much bigger problem, especially with demand that remains weak. And with a pressure coming on Lunar New Year, it's going to be hard to see more happening. And when we look at consumer expenditures, we're seeing kind of a breakdown of where those consumer expenditures are happening and how it's being spent. And food remains a big part of it, obviously not just in China, but everywhere else, where food continues to become a much bigger and bigger part of the pie with grains. I mean, China has been gobbling up and buying as much grain as possible to import to try to offset costs, to try to increase sustainability, and that's why they have all these initiatives of Clean Your Plate, and to try to eliminate food waste, because the food is going to become a much bigger problem overall. Now, when we look at India, Thailand, in terms of reserve growth, it's important to appreciate that Russia has seen their reserves grow, but this is the first time that Russia now has more gold in reserves than US dollars. So they have achieved their goal that they laid out 15 years ago to have more gold in reserves than dollars. But when we look at where the growth is, India is the one that has seen the largest change in FX reserves, which is why there's been a decline in fears on inflation. CPI has normalized a bit. They're now able to ease a bit more on the central bank side. So this is the back end of this, from South Korea down, especially Taiwan. Having these FX reserves is going to be supportive of more activity in terms of easing, because there's a bit more openness. And that's why Brazil, China are a little bit more of a problem, where in China doesn't have the same FX reserves, or I should say growth, because they obviously have over $3 trillion in FX reserves. But as exports start to come under pressure and their ability to subsidize it comes under pressure, there's going to be additional issues in terms of, well, how many of the FX reserves, they need dollars, so they've liquidated some T-bills, but they need those exports to bring in dollars. And this is where we start to see some friction, as India is going to be able to do more over the near term. But even while we've said that, bear flattening, shorter Indian bond yields have spiked. on the rupee move to tighten cash, because they tried to tighten that cash move, and you saw this near-term move where the 5-year bond spiked up, but the 10-year bond yield stayed fairly flat. So again, their ability to ease and borrow will still remain at that level. The question is going to be what is the confidence, and are we going to see a bigger turnaround in terms of activity, specifically on the Indian economic side? Because on the Chinese renminbi side versus the dollar, you can see that we're moving down to levels that we haven't been at since essentially 2016, 2018, and we're getting to the lower end of the curve. But if you're thinking about it from a USD level, you can reverse it. And it's just $1 equals 6.47 renminbi. And there's just, again, you can see the strengthening of the renminbi versus the dollar has only increased since essentially June, or I should say March into June, as the Fed did way more. And there was an opposite effect where the PBOC, while increasing debt, they were trying to minimize a certain monetary policy while everyone else was increasing monetary policy, which has created some of this pressure, which will hurt imports. Because if you think about imports that the U.S. is going to bring from China, your dollar doesn't go as far. So then your imports get impeded, which is why I'm assuming China is going to do more to try to offset this. Then when we look at, again, new loans, you can see that 2020 has crushed it. Again, the new loans cumulative year to date, you can see that the new loans continue to grind higher, which when you consider where things are around the world. So if we look at like what's happened in the United States, so far with our monthly budget statement, the survey was supposed to be at down 143.5 billion. And we came in at down to 143.6 billion. So pretty much in line with what was expected. But when we look at new loans, again, this is why we remain concerned about the debt levels and the lending within China, as how is it going to be able to continue to go as there's fears on defaults, and what the law of diminishing returns requires a higher and higher level, which we continue to see get ratcheted up over the last few years. Now, when we look at Japanese leading index and shift a bit to other areas of Asia, you can see that the Japanese leading index was right in line with expectations, a nice rally off the low. But that is coming under pressure as well, as we have an increase in lockdowns and pressure, which is limiting the high frequency data. So when we turn to the high frequency data, we can see new COVID cases continue to rise. The lockdown index has ratcheted up from 38 to 55 in essentially a 4-week period. Walking in Tokyo, transit in Tokyo, and then transit nationwide has dropped down into depressed levels, again, as the concerns of new cases continues to rise and they limit activity, which will put pressure on the different components of industrial activity, consumer spending. As we've shown last week, the week before, retail sales continue to miss, convenience store sales miss, and exports continue to underperform, as well as imports. Then when we look at India, this is something that we've shown previously on. India sees biggest GDP contraction on record this year. Again, that's why the importance of having those FX reserves will help them try to offset some of that pressure and try to essentially stimulate the economy through not only government spending, but also trying to incentivize more corporate spending and hiring. But when we look at some of the Indian new COVID cases, so you can see that new active cases continue to fall, new COVID cases continue to drop, but the bigger issue is consumer sentiment remains negative. And that is where we need to see that adjust to get people more comfortable with spending. Retail recreation remains negative. This is something, again, the weight that we continue to see within India is going to limit how much gasoline is consumed, diesel. These are the kind of this bifurcation that we continue to struggle with, especially as we see some of the leading indicators getting a bit worse. Like when we look at India industrial production year over year, the estimate was to be down 1%. Instead, it was actually down 1.9%, which is why when we looked at it, we saw a slowdown in diesel demand, which ended up materializing, which again which indicated to us that industrial production was going to miss. And again, it's just a matter of how are they going to compete against China in the export market, in the trade market. And this, again, gives us pause to where is diesel demand going to be in January as we see more pain in the global market on those trade numbers. Now, shifting gears to South Korea, we can see obviously new cases increasing, starting to level off a bit as of January. They've continued to kind of level off, but the stringency index is right there. Traffic is gone down to -13. Transportation, retail, recreation visits, all of this is pointing to, again, that shifting lower in activity. Now, we know just based on previous times in South Korea and Japan, they ratchet down, then come back up. And this is something we're going to have to watch. But the domestic flights is something that we continue to be negative on. We're seeing that remain a problem through not only just Q1, but also well into Q2, just given the limited amount of international travel as everyone waits for vaccine dissemination and just try to get comfortable with where are we going to sit going into the second half of the year. Now, offsetting some of these problems and kind of wrapping it all together when we look at Japan, as I talked about earlier with an issue on consumer spending, Japanese wages, they were expected to be down 0.9%. They were actually down 2.2%. This comes back to the consumer, the ability of the consumer to spend, the ability for the consumer to come out and actually purchase, which remains under pressure, which continues to struggle, which is leading to the decline in consumer confidence. So you can see the Japanese consumer confidence missed estimates, and it actually came in at 31.8. Again, these are problems that continue to arise throughout Asia. So now you have China, which was supposed to be the stalwart of economic growth and one of the only positives in Q1, given obviously the weakness in their Q1. So year over year, there's some softness and an easy comp. But when we look at Q4 into Q1, it's going to be difficult just given they have a new outbreak. Lunar New Year is going to be impacted, and some of their bigger trade partners continue to see some of these hiccups as China is starting to rely more and more on Japanese trade, and Japanese trade continues to struggle. So again, there's a lot of interlockings and a lot of issues that remain within India, within Asia in general, and the slowdown in economic progress is only going to increase the chances of geopolitical strife. And that's a long way of saying that people usually don't go to war when everybody's making money and the economies are booming. Typically, it's when either one is doing poorly, the other's doing well, or they're both doing poorly, and you see a ratchet up of military and other types of aggression, if you will. So these are things that we're going to continue to watch, try to highlight, and try to bring to the forefront of what we think will be either the good, bad, or ugly of the future as we head into a very uncertain Q1 and then Q2, and hopefully things start to turn around as we get into the second half of the year. So thanks again for watching. If you have any comments, please let us know. I'm on Twitter. You can email me. In the YouTube comments. Anything and everything would be great to hear from you. So thanks again. I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network.